Okay. All right. Well, I'm Arnold Kling. This is Moses Sternstein, who runs, among other things, runs a Substack called Random Walk, where he looks at he sort of combines a lot of data and a sort of sardonic humor. And I don't know, are there any other introductory remarks you want?
Um, no, I have recently somebody described Random Walk as if Matt Levine and Zero Hedge had a baby, and I kind of like that. So
Yeah, yeah. Well, that's very nice.
yeah,
They I like both of them. All right, so let me throw this first question at you, which is, we've got a lot of good data on the economy. The last month inflation rate CPI came out at zero. Unemployment is still low. The stock market is approaching records. Um, and if you could take all these trends, uh, both in the sort of the aggregate and maybe even within particular industries, and put them into two columns. One column is sustainable and the other column is unsustainable. What would you put in the sustainable column?
yeah. So I mean, I'm sort of thinking this through on the fly, and I mean, with the caveat that over what time horizon, I think is it sort of is important. Like I think like so, for example, well, I think low unemployment is probably pretty sustainable. There's no reason necessarily that unemployment has to get significantly higher, especially if, we don't have a continuous stream of more people to, looking for work. Like the labor market in the US is secularly tight. I mean, this is sort of a big theme as we're getting older that just, puts more work to be done for fewer people to do it. So you can, assume absent some shock that unemployment will stay pretty low. I think the unsustainable part of it, of course, is like who's paying for all of that and who's creating demand for labor, and a lot of that is has been healthcare, right? And healthcare is largely funded by the public fisc, and everybody agrees that the current rate and pace of deficit spending is not something that's sustainable in the long term. When that reckoning comes, how it's resolved, nobody really knows or wants to think about in any way. That's not terrifying. But I think Uncle Sam has proved to be a fairly resilient consumer, is relatively price inelastic, is insensitive. The prices go up and it doesn't really stop consumption behavior, especially when it comes to healthcare. So like, there may be some increases in efficiency that will, or increases in productivity there, but for the most part, like we're getting older, and old people are not they're not wealthier, which means they can't really pay for it themselves, and they may also have some of those comorbidities that lower income people tend to have. So you can expect that we have a sort of secular increase in demand for healthcare consumption, so that will provide jobs. So I think I don't know where that falls. I mean, I think that's partly sustainable, but of course it's driven by something that's fundamentally unsustainable. So I guess that's a bit of both. Um,
So to put it briefly, I'll try to imitate you a little bit, talk like you. We've got uh, a lot of new immigrant labor that's changing our grandparents' diapers paid for by the government. Is that kind of a
yeah, I call it
Sternsteinian description of the economy?
the Uncle Sam's Immigrant Nursing Brigade, right? I mean, if you look at all of the net new job growth has gone to foreign-born workers, which, again, that's just a fact, like whether that's a good or bad. And healthcare has been about 40% of the job gains since the beginning of 2023, so over a year and a half. Is healthcare domestic product? Healthcare makes all the jobs. However, I've variously tagged it. I mean, that is true, and those jobs are largely they are going to immigrants. And again, like that's not a preference or a, oh, they're doing the jobs that we won't kind of thing. Is like the native born population is not growing. So if there's this, it's getting older, and so if you're right, I think that the
There's
somebody's got to
no
do
one
it,
else.
and yeah,
There's not enough other people to change the diapers. It's just, so
yeah,
somebody's got to do it.
right, and we, again, other countries, have taken a different, like, you look at China. China has invested much more substantially in robotics, and they have taken a different approach to potentially to solving, being on the wrong side of the aging curve with automation and things like that. I don't know how successful they've been, or again, how long you need to judge whether they've been successful at that. But at some fundamental level, yeah, that is the biggest growth story of the last year and a half. All the jobs that we've added, the growth that we've created is substantially. It has been, it's the Uncle Sam's Immigrant Nursing Brigade. It is just sort of filling a labor gap with foreign-born workers. It's not perfectly one-to-one, obviously, because there are substitution effects that people may leave childcare and go to work in nursing, et cetera, et cetera. But like that's the basic idea. Um, and I don't see that stopping anytime soon, if only because I can't imagine what would happen if it did, right? I think we'd have much bigger issues, but that does seem to be an enduring something.
But let me
Yeah.
let me switch to a different topic, which is the stock market. Is the stock market is not uniformly rising? Am I correct? It's still mostly the Magnificent Seven or some subset of tech stocks?
Yeah, I mean that's exactly right. So like again, depending on how you want to frame it, you could frame it somewhat bearishly and say there's huge concentration risk, which is true. Um, that there's almost a huge chunk of the performance is basically weighted in a few names, and if it's not those names specifically, then it's sort of one step removed for them. It's the energy. We can get to that in a second, but like, yeah, I mean that is absolutely true. Now, the flip side of that is to say, okay, that means this isn't just pure froth. Investors are being smart and discerning. Like they mostly are staying away from unprofitable companies for sure, and even profitable companies, if they're not growing that prodigiously, then the multiple that investors are willing to pay for them is just not that high. It's still kind of high, but it's not insanely high, relative to what you
But
can get, at the risk-free rate. So, for the big companies, so we do see these outsized performance from a small number of firms. And again, the bearish analogies, you say, okay, let's look at the dot-com bubble, right? Where even though there was, in the longer term, investors were right. Like the internet was a huge thing. In the short term, obviously, they got head over skis, and Cisco is the sort of classic analogy. Cisco is this infrastructure company. Everybody's super excited about it because everybody assumes that as networking generally grows, the one beneficiary of that is going to be Cisco, and this will go on forever. And even if this is CapEx may take some time to earn back, it's long and enduring, and et cetera, et cetera. And like again, over a long enough time horizon, they were sort of right, but it did blow up in
well,
their
let me
face. But
give you
the
another
funny,
name
yeah,
besides
yeah.
Cisco. You know the name Bernie Ebbers? Does that mean anything to you?
Um, it does, but I'm not uh
WorldCom.
WorldCom, right? I was like,
Okay.
it's not Arthur
So
Anderson.
yeah,
Yeah.
so they did even worse than Cisco. Yeah, and I call this sort of the picks and shovels theory of investing, right? That well, we don't know which miner is going to strike gold, but if we make picks and shovels, we'll do well. And investors really adopted that, or some investors really adopted that during the dot-com boom. They said, well, if you have something to do with fiber or routers like Cisco or fiber like WorldCom, you're bound to do fine. And so they got ahead of themselves. And I think that's you know it could turn out to be true with NVIDIA or somebody like that. I think that's
Yeah, I think that's the exact right analogy. The differences are NVIDIA is still not as expensive on a price to earnings basis as some of those companies were. So like as crazy as it is, it's not crazy as it was. And NVIDIA is generating real revenue, and it's all the CapEx that the big hyperscalers have committed to make, and they're doing it and putting on their balance sheets. And some huge chunk of that's going straight to NVIDIA. So you can sort of see it happening. And presumably it will reach a peak, and also I think the big concern is at what point, there are it's got to these investments have to start generating real returns. People can wait for some amount of time, but you can't keep spending, hundreds of billions of dollars on CapEx without generating, or at least having some path to generating ROI. So that hasn't happened yet, but that doesn't have to happen yet, but it will at some point soon. The other, I think, interesting difference between, and this is sort of a bearish one, is just like, okay, you make the analogy to fiber or to utility or to railroads or some other piece of enduring infrastructure. One thing that I'm not the only one to make this point, and some of it is my own lack of knowledge, is like the GPUs, as I understand them, they actually, they do get obsolete. So it's not like a railroad, which you can then use for 20, 25 years. Within a couple of years, they do actually have to, there's going to be a next better thing. Now maybe, how it works is the same way that other luxury goods work, where, the fanciest GPUs are paid for by the bleeding edge companies, the ones with the most money. And then further down, companies, for the models that used to be bleeding edge and they're still usable by, is 5 or 6, 7, 8 years down the road by somebody with less deep pockets, but still that's a shorter time horizon. So that's sort of an additional cause for concern. It's just like these are not. It's not the analogy to infrastructure isn't actually, isn't quite perfect, because this is not necessarily enduring stuff. And that's in some ways, like, I think I don't think it's cynical, but like at least some of the argument around the AI safetyism and the desire for regulation is like some of these big shops might think, hey, we need a little time to do some rent seeking here, so that we can earn money on these huge investments that we're making. Because if you let the sort of cycle time be too quick, we're not going to be able to generate enough ROI on the CapEx that we're making. And I don't, again, I don't know if that's necessarily true, but like it's at least plausible to me.
Yeah,
But
I
that's
think
part of what's,
there's just a lot of unknowns in this whole AI area. I was just reading this, I guess Tyler Cowen linked to Ben Thompson's talking with Daniel Gross and Nat Friedman. And I think it was Friedman who pointed out that there are kind of, several views of what sort of the binding constraint in AI is going to be. Like one view is like, well, if you just get more computer power, you'll get better results. Another model is if you get more data, you'll get better results. Another model is you'll need a different algorithm. Maybe we've gotten as far as we can with the transformer algorithm. Another model is maybe you need a whole new generation of AI researchers. And another model is that you don't have the applications yet. And that's actually the one I'm most sympathetic to. And the applications take quite a while. And if that's true, then we maybe haven't even met the winners, right? The winner will be the person who develops. I mean, my favorite applications, hypothetically, would be robots that you can, change their behavior just by talking to them. So you can say, hey, fold that laundry and sort it put it in the sock drawer. That would be one. Or people talk about the AI tutor that lives with your child year after year and helps times its tutoring of them to their needs. And the other one that people describe, I think this was also that same podcast, the notion of a kind of a digital clone. So I could be talking to you, or maybe my clone could be talking to you, and meanwhile I'm doing something else, and we can we can get things done. Anyway, those would be really spectacular. It's not obvious to me that those have to be developed by a big publicly traded company. Why maybe somebody working out of a garage is the one who really gets those applications going. Is that plausible or?
I mean, yeah, so it's definitely, again, I tend to agree with you that I think sort of efforts to sort of really forecast what, if you believe it's a transformational technology, trying to assume what that's going to look like seems almost like a contradiction in terms. So like, I agree. I don't, it's totally plausible that we don't know who the winners are, what they look like, and how, what winning will even manifest as. Um, I, starting like in terms of what you touched on, like, I mean, yes, I would love, if we had, if, getting back to where we started, like if you think that secular aging is going to be a persistent problem for a long time, and particularly, this sort of demand for low-end service work in teaching, childcare, elder care, all of the menial technique, all of these things, like then having development there, which, again, is combination. It's not just the LLMs, it's also, that's a pretty substantial hardware challenge too, and hardware is expensive and long and fraught with peril. But yeah, I think that would be great. I also, for the app side of it, I mean, part of where my head goes is I begin to think of, again, I come back to the investor question is where do you get return on investment? Where's defensibility? And in all of those cases, there may be a consumer app that then sort of builds defensibility around massive network effects, where nobody knew about, Instagram took the pictures out of Facebook and just focused on that and built a huge product. And then of course, Facebook ended up buying them. But it worked not just because of the features there, but because it gained huge numbers of participants that's the part that couldn't easily be replicated. So when it comes to AI, it's sort of these questions, okay, there's all kinds of so-called vertical set, point solutions, things that are being built for specific workflows, and they all sound like kind of nice businesses. And actually, Slow Ventures, I'm like, why am I playing? Sam Lesson, I think, has sort of been good on this, talking about, sort of skeptical of the early stage AI hypothesis, which is like, okay, great, you could build these meaningful businesses with just a little bit of money around it, something around AI. And I was like, that's probably true, but it's unclear how big they can get, and whether or not they can justify the risk that VC checks typically take, right? And so VC works on the sort of the power law model where you assume that 9 out of 10 of your investments are going to burn up, but that 10th one is going to 100x, and that's where you're going to generate all your returns. But if you're generating lots of small little companies that somebody else can easily then create a competing AI tutor, is going to be lots of nice small little businesses. And whoever is providing the back end there, the picks and shovels, they could make a lot of money. But the individual sort of apps, as you would describe them, those might be there might be a sort of small business revival or something like that.
Yeah,
But I
yeah,
don't know that there's any one
yeah,
big winner. Yeah.
yeah, that's one scenario. And I guess this podcast I was referring to, all these guys like, especially Ben Thompson and Daniel Gross are just gushing over Apple. And I think the reason they are is that Apple has a moat, right? So
Yeah.
anything, so if Apple becomes the consumer interface to AI, then you can see profits because they have this moat. But
Yeah.
if and that and I just come out on the bare end on Apple just because I don't see. I mean, I think if the smartphone is still the way we interact with computers 5 years from now, then AI has failed, would be my line. That, I find the announcements at the Apple AI developers thing just really lame. Like, why? Like
So,
just yesterday, I was making a reservation on an Amtrak train, and I didn't even have the Amtrak app, so I download the Amtrak app and I go through and get my credit card in there. But the process took 5 minutes. Uh, if and So you can imagine a world where I can say, Siri, get me on an Amtrak train to New York, and it takes 10 seconds. Well, is that worth hundreds of billions of dollars? That like little incremental thing. So anyway,
I mean, I think part again, like Daniel Gross and Ben Thompson have forgotten more about, well, certainly Ben Thompson about Apple, Daniel Gross about AI than I'll ever know. and actually it's funny, I've talked to Daniel Gross about some of the analogies to Cisco and the dot-com era, but like I think my understanding of why Apple has gone from laggard to winner is really, if going back to the question of bottlenecks, if one bottleneck is user data, and that will be huge alpha for whoever has the best new training data to evolve better and better models will win, then Apple doesn't actually have to do anything on the AI development front. All it has to say is like, if you want an iPhone, you have to opt into OpenAI data sharing, and all of a sudden people are going to be like, okay, I really love my iPhone, and now OpenAI has the greatest data moat, new training data moat in the universe. And I think that's at least partly my understanding. Like, there may not be iPhones in the end of the day that's transformative. It's just that because people want AI, it will build out the training data moat, and then therefore they'll just maintain model superiority from now until forever. And it may be that you're right, 10 years from now, people aren't even using what we call an iPhone, but because the top of funnel was using the iPhone to train for OpenAI's purposes only, then their models just get so much better than everybody else's, and that's how they win. At least that's my understanding of it, but I could be wrong. But even actually just taking a step back on the stock market, I think where it gets kind of interesting is like it's not even just Nvidia and some of those names. It's also like the sort of secondary trade has been around a lot of the energy companies and the infrastructure and data centers and anything involved, right? Because if part of the hypothesis is like, okay, the computational demands of AI are enormous and the energy demands of that kind of computation are enormous, therefore it stands to reason, and we've seen it already, is like, we're going to need more energy and we're going to need more data centers, and that's some combination of like getting more energy to those data centers, cooling them better, being more efficient, and there's just huge assumptions being made and huge investments being made, grid transformation, all kinds of things. And some of them are made by public utilities, some of these are made by private companies around, this assumption that we're going to need to consume more energy. And the big overhang there is, of course, is just like, well, what if we get more efficient, which we have in the past,
Yeah.
right? And so like even if
an
yeah,
argument I've seen is that uh, renewable energies or energy is actually cheap. Let's assume and that there's a big supply elasticity there, but there is a huge need then for a grid overhaul. And so is
yeah.
that the big bet that people are making? And I I guess I don't see stories about that happening. Maybe it is behind the scenes that we're actually developing some kind of grid that can take electric, can take wind power from Texas and put it into cars in New York. I don't
So it really
that
does. It depends, because I think some of these. So it's true that renewables can be cheap, but they're also, as of now, not terribly reliable. Because they're so. They if it's not sunny, if it's not windy, then you don't have power. That doesn't necessarily matter depending on what your latency, what your latency concerns are. But and that's also the same as true of distance. So like I think it's like I had, as Arnold Kling would say, there's specialization in trade, and these are heterogeneous markets, and there's going to be a lot of differentiation, and it will clearly help that there is wind and solar and people are investing behind these things, and people are also investing in better storage to sort of try to alleviate the steady state versus the more interval based stuff. But most people that I spoken to seem to think that in the near term it's going to be LNG, which frankly we have a lot of cheaply available, so that's not necessarily a bad thing, but like that's the clean, reliable source of energy that people will need. On the grid side it's some of it is just a question of like we don't have grid. It's not necessarily transferring the solar and the wind, but like a capable of transferring the degree, the amount of power that is needed and will be needed over extensive periods of time to run the data centers. And again, my anecdotal understanding is like there is work that's going on there. It's not necessarily going to look at like new power lines so much as overhauling the existing power lines, but like if you talk to real estate developers, like it's hard to, there's a shortage right now of some of the basic like electrical components that they would need to just finish a development, because all of that stuff is being hoovered up by data center companies who are trying to build more and more of these, and have more and more power that they have to navigate.
I'd be curious
um
as to where geographically they're putting these data centers. Are they betting on fracking or liquid natural gas and locating there, or are they betting on wind and solar and locating there?
I think it again. It'll be a column A, column B. Like I think if to the extent that data centers will want to source some of their energy from solar and wind, um, and if they can, and there's a lot of companies that are now trying to more efficiently manage that sort of sourcing process so that, okay, when you need solar and wind, you'll get it only for the stuff that, that doesn't need steady state power and only in the right times. And then when you need steady state power, you get it from LNG. But also like some data centers can be used for low latency stuff where it doesn't matter how far away you are from your data center. And some, like the stuff that Langley's building in near you, Virginia, which is a super hot area for data centers. Presumably they want it closer, both for security reasons and for latency reasons. But like Columbus, Ohio, part of why Columbus, Ohio is experiencing some of its revival is, I don't know, like Columbus is one of my favorite little under the radar markets in the country is because there's both like Intel, a plant that's going down there, but also that Google is building a big campus there and there's a big data center there and they actually have grid capacity to build more stuff. And so that's where some of it's going. But also Saudis, the Gulf is building some of this stuff. And presumably that will be for use cases where proximity and latency don't matter as much, but they certainly have plenty of energy and plenty of space. And,
Plenty of sun.
yeah. What'd you say? And
Plenty
sun,
of
yeah, and oil. I mean, what I like to joke when I sort of make fun of when I make fun of housing yimbys, who are so, in my view, sort of selectively um, jaundiced against, land use and zoning regulations because it suits them, as I think the moment that, prized real estate development starts going to data centers rather than multifamily properties, they're gonna rediscover land use regulation again. Like for example in Virginia and things like that. So I think if things go according to plan, it'll definitely create some huge opportunity. It's the only thing real estate has going for it for the most part in a growth way, sort of data, is the data center stuff. But in terms of whether it's sustainable, I think it sounds like there's still a decent amount of haggling going on behind the scenes as to who is going to take that risk of sustainability. And then you have these pre-purchase agreements, like where utilities are saying, look, if you want me to, invest all of this money into my grid or to power generation, I need to know that you're gonna buy all this power. And you're going to have to commit to it for X number of years. And sometimes the data centers commit to it. Sometimes they pass those commitments on to the hyperscalers. And sometimes the hyperscalers will say, no, everybody wants my business. There's only 5 or 6 of us. And, so we get to dictate terms here. And we don't want to take that risk. And there've even been, again, anecdotally, like I've even heard of some scenarios where, the opposite happens, where data centers will say in their kind of exuberance, they tell the utility we expect to use 3 times as much energy or something like that as we need. And so, the utilities work hard to sort of make that available. Then it turns out they don't need nearly as much of that. Then the utilities are very annoyed. And then at that point, they come the next time there's a big ask for, additional capacity, they become more skeptical. So those are I don't know, again, those are anecdotes, but that's the sort of, there's a lot of very exuberant capex, which is good and is driving, I think, a lot of positive innovation. And is if you want to be spending money on something, spending money on that kind of stuff, it seems as good a bet as any. But there's still a lot of these are all it's all very contingent on somebody being able to actually generate revenue, and they're sort of these series of nested assumptions there that people will be able to generate revenue over a right time horizon, and that the bottlenecks are in fact energy. In the way that they say they are, when these things they can change pretty quickly.
All right, let me give
Yeah.
one more sector, and then let me give everyone else a warning that start thinking of questions or your own comments and start signaling in some way that you want to get in on the discussion. That sector is the banking sector. Is there something scary lying just below the surface in the banking sector?
So it's funny. Banking is tomorrow's post. So it's actually, I mean, the answer is yes, kind of. But I actually think the more interesting thing is like it's not scary, it's boring, right? Is like are we trying to make what we recognize as depository institutions, sort of some more similar to zombie banks or just boring banks, where they don't, where their ability to generate revenue and generate revenue profitably just slowly begins to depreciate over time, such that they're not attractive enough to generate interest from investors, right? And then or an investor will say, look, just from a return on equity standpoint, this isn't generating enough yield to make it worth my while, and then they become sort of quasi utilities like they are in Europe. That was like the sort of finger in the not finger in the air, but I certainly did my homework and ran it by people who know the sector much better than I do. But that was kind of the impression that I got from the last FDIC report. Is just like they're not, the simple story is to say, look, their cost of capital went up, interest rates went up. That's going to be painful in the short term, and the Fed sort of cured a lot of that by jumping on its own grenade and saying all these low interest assets that I've now devalued, we're going to allow you to treat them at par. Fine. But like the idea would be is okay, as time goes on, at least they would, they may have to pay more for their capital, but at least they could charge more too, and it should balance out. The issue is like, okay, that's great, but can banks actually, are they, willing and or able to find a market for their kind of loans at the rates, that they would need to charge, given their own regulatory requirements and safety needs and just the higher cost of capital in general? And the answer thus far has kind of been no, like, because they may want to charge 10, 12, whatever it is, 10 or 12%, but real estate's not borrowing at that, certainly not for longer periods of time. They're not borrowing at that. Their deals don't pencil. You're not doing, leverage buyouts or capital market, like the kind of stuff that they might do, or even asset-based lending or just regular business lending, is that no one can afford those. They can't find a market at those higher price points. So what they've done is they've done a lot of, and there's no mortgage lending right now, and there's been very little auto lending. There was just a ton of credit card lending, which is high yield for a shorter term, has some inherent risks there, but that's what they've been doing to tread water, and sort of what I've been looking for, is some evidence. And there are people, and some of the banks are saying that this is what's happening, is okay, their net interest margin is nearing the bottom and things are just going to turn around and we're going to start making more money again. And maybe they're right. I mean, certainly auto is starting to pick back up again, but like, it just, they are, it doesn't, revenue, the latest report just showed it continued, that their NIM was continuing to go down, and their, revenues were flat to down. And they haven't been able, consumer lending is cyclical. So like a lot of the credit card stuff went away in the first quarter, which is to be expected, but they didn't make up for it anywhere else. So it's almost like,
but who's
go ahead.
who's doing stuff at a profit? I mean, it's not like you're the big cheerleader for private equity these days, right?
No, I mean, so some of it is just there isn't a lot of it. That's the kind of the amazing thing, is just like lending. There's just less credit creation than there used to be, and it's kind of remarkable how little impact that's had. Private credit has been doing very nicely. They've raised a lot of money, and I think, and they will charge higher rates. They move more quickly. In theory, they're more flexible or more agile around some of the risk provisions, and the kind of collateral they'll be willing to take. They're just more nimble than what traditional banks are, can do, or what regulators will let them do. And they're also, again, they're playing with investor money, not deposits. So the constraints are, correct, rightfully looser there. But my understanding of this, again, is like a lot of this stuff is shorter term. It's picking up, pennies in front of a steamroller, insofar as they're filling the void that banks used to fill, or that, frankly, that equity checks used to fill, and they're lending to portfolio companies, they're lending to GPs on fairly short-term basis, and they charge not insignificant amounts, but even that market is not that big, right? They are, and some people will say that, like, there's more demand than there is, there's more demand for private credit to put money to work than there is good places to do it. And so maybe yields have compressed beyond the point of, safe risk return. But so the answer is like, there's just been less credit creation, and it's kind of remarkable how that hasn't mattered. But to the extent there's not private credit has done done a lot of that work.
And what about the
Um,
existing balance sheets of both, banks are sitting there on some pretty, smelly commercial real estate loans.
yeah,
And
so that's going to be bad. It already is, but like again, like it's the train
do you
wreck,
think
the
the
slow moving
Fed's
train
gonna
wreck.
keep those balls in the air and not drop any of them in some sense?
I mean, they've done a pretty good job up until now. It's will there have to be big surprises for things to go sideways, right? Like we can live with some bank failures. We've already seen some of that. We know that equity investors in some of the peak, private equity deals and real estate, especially, have already gotten wiped out, and people are selling things at a discount. And so, like, there's some pain, but it hasn't, led to widespread contagion. It hasn't, led to any. The one thing that almost happened was right at the beginning, right? Is when the Fed initially basically, torpedoed all of that low interest stuff, and the banks were functionally insolvent, and that was a liquidity problem. But the bank, the BTFP did fill that gap. Um, if there's any,
That's the Bank
one pop,
Term Funding Program, or,
right?
another bailout for short.
Yeah.
Okay. Does anyone in the audience, anyone else want to raise either a virtual and actual hand? Let's Mike L. Go
Yeah, so
ahead.
just piggybacking on the last comment there with the BTFP, that kicked the can down the road for a year, and I know it recently expired, but it's not like all those assets magically became better. Like the rate environment's very similar. So what's going on there?
Some of it is that the lending, has moved to the discount window, which is what the Fed wanted. They said, take some of the stigma away from the discount window, use this instead. So there's definitely some of that. There's some of it has gone behind the scenes, and like the number of troubled banks did increase. And that might be the continuing sort of souring of some of these books. But at some level, it's just like, right? I mean, it's fractional reserve banking. As long as they don't need to sell those assets to raise cash, then they can continue to be okay. And it's true. If they had to actually, if they needed to use those, if they had to turn those unrealized losses into realized losses, it would be pretty devastating. But so far, it just hasn't been the case. Either people aren't, in some ways, like, a run is a rational. If a bank run's starting, if panic has started, the rational thing is to panic at that point. And then maybe the Fed has just done a good job of convincing people that, like, if there's ever a panic, we will, we're gonna step in. So no reason to panic, and maybe that's worked. I don't know. I mean, the unrealized losses are basically a function of interest rates at this point, and they got a little bit better when rates went down, and then they got a little bit worse when rates went back up. But no, as long as, I mean, it's kind of the broader story of asset prices generally, which is like, in terms of, and again, to ask the question of how sustainable these things are, is like, as long as nobody has to sell, it can continue to stay, they can continue to stay high for a while. And that's true across all the asset classes: housing, private equity, public equities as well. So you kind of ask the question, well, what would cause people to have to sell? Like, where would where would they have a sudden need for liquidity? Um, And that could be a lot of things. I mean, there could be a pension fund that needs to make good on its commitments. That could be some natural disaster. That could be, an oopsie in one part of the economy that caused people to lose their job, where somebody then says, okay, now I need this rainy day fund, which I didn't think I needed. Now I do need it. So can I get my money back, please? And it can happen in all kinds of different ways. But for the most part, it just hasn't happened. People have kept their jobs. Like, the last real rainy day we had was the pandemic, and rather than needing to tap any rainy day fund, the government injected a few $1 trillion to make sure that we didn't have to.
All right.
Yeah.
Any other questions, comments? Okay, well, so again, we've had all this good news. You've made this an argument for why the low unemployment shouldn't go away quickly, and I think that sounds right. I mean, like you say, there could be some real external shock that changes that, but I guess what I have a hard time seeing is the inflation numbers continuing to be good. I mean, you're still running $1 trillion deficits. They're the I don't see anything spectacular on the productivity front. So at some point, all this sort of paper wealth that the government's creating, just the classic too much money chasing too few goods. And again, and especially in an environment where the Fed has to be very leery of all these, potential financial problems. So every time the Fed really wants to shrink its balance sheet or whatever, it's going to be, it's going to twitch every time, there's a problem in the banking system or a problem somewhere else. So anyway, that's so to me the thing to watch for in the bad news department would be on inflation.
I guess I don't know why. I could certainly see inflation as being a second order consequence of some other, as you say, like if the Fed decides to shimmy and shake for some other reason or intervene for some other reason, then inflation could come back. But as things currently stand, like I don't, my model of inflation or inflations is, at the beginning, if it was very much an increase in money and just like there was just more money sloshing around, like the more enduring thing has been secular aging, the labor shortage, which with the pull forward of retirement. But like, and the reason that inflation has slowed, it's slowed in tandem with with the supply of labor catching up to the pre-existing levels of demand. And like it's actually kind of neat, right? You just sit there and as if the ratio of job openings to job seekers at the peak of inflation was something like, I think was over 2 to 1, and pre-pandemic was like 1 point. We're basically at pre-pandemic levels. We've restored pre-pandemic parity. So right now it's not an excessively favorable, worker-friendly thing. And of course, when you have a worker shortage, wages go up, and service prices go up, and that was inflation. But that seems to have, as we've had mostly the open border, but some of it's also teenagers getting back to work, some of it's retirees getting back to work. It's brought parity back to the labor market, and inflation has cooled accordingly. So now the question is just like, why would inflation, in some ways the bigger concern is where is growth going to come from such that it would cause inflation to rise again? And that's where, I could see sort of the continuing, healthcare won't continue to grow as quickly as it did for the last 2 years because now it's all caught up, but it will continue to grow, and that it will continue to be a source of cost inflation on the labor side, and healthcare is going to get more expensive. And but I see that as kind of like more slow and steady rather than acute. But the bigger issue is, okay, what happens to everybody else, right? I mean, and maybe what you were saying is like, okay, if we get to this kind of slow growth economy where the only sector that's growing is Uncle Sam's Immigrant Nursing Brigade, then people get antsy, and we lower rates to sort of to get everything going
No,
again, and then okay,
that wouldn't be my
yeah,
picture. My picture is that
oh,
we're already, getting enough sort of fiscal stimulus, as it were, just, wealth printing. So, people are, they're just, I guess the scenario is just the interest on the government debt, which, they say this year it broke the point where it exceeded defense spending. Next year it'll exceed Medicare. Who knows year
right,
after that. And um, so I guess the risk is uh, at some point the bond market says no mas. You're throwing too much paper at us. You're going to have to pay higher rates, and then those higher rates mean that you're spending more, and you're really you start behaving a little like Zimbabwe in the old days or Argentina.
right. Right. Yeah, if quite right. So that's the other thing that would happen is if the Fed has to intervene just to meet Uncle Sam's rapacious borrowing needs, and quantitative tapering comes to an end, and yeah, we go back to a regime of yeah, that I agree with. I mean, like I basically I agree that Uncle's, whatever the public fisc is a persistent inflationary force. I just don't see it as being it can continue in a kind of gradual upward steady state that, that's probably a little bit nonlinear. But I agree, it's like very susceptible to that kind of shock where it's just like at a certain point, either, there's just not enough money around. It can happen two ways. It could happen, there's not enough money around to meet Uncle Sam's need, therefore the Fed has to step in and just begin, growing its own balance sheet again, or as a result of Uncle Sam hogging all the money with whatever yields it's willing to pay. Because again, it's fairly price insensitive. It's like, okay, if the market, if I have a bad auction and it doesn't matter that the rates are 3%, you're telling me I pay 5%, then I'll pay 5%, then nobody else has any money left over. And that actually eventually does cause some kind of recession. And then same thing where the Fed, okay, now I have to lower rates. I got to increase the money supply because, Uncle Sam can't be the only game in town. So yeah, yes, but I don't know over what time horizon that would happen. And, the treasury auctions were pretty good this past, they were bad 2 times ago. They were pretty good last time. So who knows? And again, I think that is sort of an interesting phenomenon too, which we didn't really talk about. It's just like who, maybe there's, who is the marginal buyer of treasuries at this point? Because it's not China anymore. It's not sovereigns. It has to be investors. But one of the, it's been households, hedge funds, pensions, and and they are price sensitive. So if yields were to go down, presumably they would move their money elsewhere, and that wouldn't necessarily stop Uncle Sam from auctioning off more money. So yields would go right back up. But one of the interesting things, and this was something I'm blanking on her name, but she's very, very smart. She's like the CIO at Bridgewater, and she made one of those observations that I can't stop thinking about, and it kind of keeps recurring, which is just like an unexpected tailwind for the US is that it's the only game in town, right? There's nowhere else to put your money. So demand for dollar denominated risk is just still so high. So it's like, there was as emerging
The old
markets
tallest
become,
pygmy story.
exactly. And it's kind of amazing. And it's just like, it doesn't really matter, what kind of scenario is the dollar and gold appreciating at the same time? It's bizarre. The scenario is the
And
one that we're in,
Bitcoin.
which is like, there's literally nowhere else to put your money. Not emerging markets, China is considered uninvestable. India is kind of a dark horse there, but India still has some state capacity fraud issues and it makes people skittish. And Europe is, a nursing home / mausoleum. And, I don't, being a little facetious, but only a little. So where else do you go? And there's still plenty of cash. Again, like people haven't needed to break the rainy day fund. There's been no reason for them to spend down their cash. So they just need a place to put it. And they've been compounding 5% from treasury. So why not? And that's kind of one of those, tallest pygmy or too big to fail or something, but it's working in our favor perversely enough.
Okay, if there are no more hands from the audience, I think we've had a spirited discussion, and I think I'll thank everybody and especially thank Moses and say good night.
Thank you. It's always a pleasure.
That was good.